like the way that we start each of our sessions with a small, intimate group of knowledgeable people who know to come back after afternoon tea. Did you have a nice afternoon tea? It was okay? It's the first time I've had afternoon tea here. It was very nice, actually. Yes, there's just there's the three of us here. Actually, there's another 30 or 40 other people taking. I'm glad you're enjoying yourselves. It's nice to see many smiling faces, and there's so many reasons to be happy here, including the presentation that we're about to hear next from Mr. Warwick Hazeldine, who's about to join me up on stage. And this is a man with a very illustrious career. But what he's going to talk to us about today is the company that he's involved in called Evian Group. Now, they're capturing some a lot of attention at the moment with their strategic moves in the graphite sector, which is something that we haven't talked a lot about at all during this particular conference. So, now the company has initiated shipments of expandable graphite from its Indian joint venture, and that signals for them a really interesting new revenue stream. Additionally, they have recently secured a tidy sum of money, which I'm sure we're about to hear more about. And I think that really speaks to investor confidence in what it is they're doing. So should we become an investor? Let's find out a little bit more. Would you please welcome Warwick Hazeldine, Evian's non-executive director.
Well, thank you, Chrissy, and thank you to Vertical Events, the team, Stuart, AJ and Gloria and Tribeca for hosting this event. It's business is about relationships, and certainly what they're doing here today is forming new relationships. I want you to think graphite when you think Evian, and most importantly I want you to think that we're a vertically integrated global producer. I don't use that word producer lightly. There is our disclaimer as per the ASX, read it at your leisure. In business, it's important to have optionality, and the business model we've developed for Evian is one that has a number of options. I'm here to share with you that we're actually generating revenue, profitable revenue at this point in time. We've had our first shipment of graphite leave the shores of India only 2 weeks ago, and that's under a 50-50 joint venture, which is delivering to European and other markets. We also have a downstream process which DFS is underway or being completed, and this is our project in Madagascar, all in graphite, and ultimately we're looking at a battery anode project in Germany, which we've also completed a scoping study. And I think with some of the geopolitics happening around the world, I encourage you all to keep an eye on the Trump tariffs tonight. I think the tariffs linked to China may create a lot of attention. So we are one of only 4 companies on the ASX producing graphite and exporting it around the globe. And the ultimate is the world is electrifying. That's not new to anyone. So there's 2 sides to graphite. There's the expandable graphite, which is attracting a premium in the market, and there's the spherical graphite. We're fortunate enough to have both sides of the equation covered, and that's through our project in India, which I'll show you the crown jewels in a moment. And also, people ask me, what's graphite used for? Well, flame retardant, flexible coils, conductive additives. It's not just all going into the battery, but the ultimate for us is to start building out this business in Europe over coming years. This is the crown, the jewel in the crowns, and this is our production facility in Pune. We built this for around $6 million USD. We commissioned it inside 2 years, and we have a rapid ramp up proposed, and that will kick into our bottom line in the next 12 months, which I'll demonstrate shortly. In our joint venture, which I'll say is a 50-50 joint venture with the Panthera Graphite Technologies, we established it with Medichem, and they're experienced in graphite producer with over 20 years experience. The production facility, and I'll give credit to Pune here, is in a special economic zone adjacent to key transport. If you look closely at the previous picture, you'll see, which is on the ASX, that there's main roads running by us. It's very infrastructure rich. And ultimately, operations commenced in Q4 last year with a maiden shipment in March, and that signals money in the door for our joint venture, which we're very proud of. There is strong global interest in our Indian operations. It's well located to service many parts of the world, and we'll continue to meet the growing demand both in India, Europe, and I guess this part of the world, Asia. and we are one of the only of a handful of ASX companies, like I said, that is currently in production. One really important point is we buy our graphite in the open market, and we're able then to produce it through our jewel in the crown, our production facility, make enough margin to make a profit even at this part of the cycle. And I think that's a really important point. This is our staged approach. It's the 3 stages of growth. We're currently in stage 1, which is 2,500 tonnes per annum. Graphite, we now have raised enough money to deliver stage 2 ramp up, which will take us to 4,500 tonnes. And the ultimate is to deliver a 10,000 tonne per annum facility in India. What does that equate to in terms of bottom line? If you remember year 1, $7 million. This is in our joint venture. 2026, we're ramping up to that 4,000 tonne to 4,500, and then ultimately the big growth will come in 2027. This is achievable. It's well funded so far, at least to the phase 2. And thank our broker, Euroz Hartleys, who covered this stock. I'd encourage you to contact the company if you'd like to get that research. The feasibility numbers of the project I've just talked about, our PGT joint venture, are there in front of you. You can see we have a 50% share in that project, which is on the bottom line, and it shows to you that, you know, the smallest fish are often the sweetest, and for us, having an ability to self-fund and create profit and cash flow for a company at this stage is something that we feel is a point of difference in the market and well worth looking at. I'll now move to India, beyond India, into our project in Madagascar, and that's the Maneri Graphite Project. That's a high-grade flake business in Madagascar. Many people in the room are asking, what do you know about Madagascar? In terms of Madagascar as a jurisdiction, you can see on the slide in front of me, in front of you, that there are companies the size of Rio Tinto operating in Madagascar. Next Source will pay tribute to one of our peers also in the same space as us, and ultimately Toliara port infrastructure. So Madagascar is home to the many mining companies. One really important point is it's actually the largest producer and exporter of graphite in the world outside of China, and I don't want to harp on, but keep an eye on the tariffs tonight. I think you'll get quite a surprise on how that's going to play out. That's another form of that graph. It shows that we've got established mining jurisdiction. We're spending a lot of time in country. We've built a team in Madagascar, driven by Lydia, who I'd pay tribute to the tremendous work she's doing with the community in country. We're having direct engagement with the minister. We're working extremely hard with the EU and other large parts of the world to help fund, including the World Bank, these types of projects. But what I would say is, as a mining jurisdiction, Madagascar is a good place to do business, and certainly the mining law and the way we work is very familiar and very comfortable to ASX company. The project, the Maneri mine, is a large, high-grade resource with a long-term upside. And these are our numbers which are currently on the ASX as our feasibility. You can see that this is a long-life project which will deliver significant upside to our shareholders. It needs to be funded, and that's not lost on our board, but at the right time we'll certainly bring this to market and enjoy those benefits for all of our shareholders. In terms of our pathway, I'm pleased to share we've already completed the high-grade resource has been established. We've done the DFS. Permanent licensing and approvals is underway, and that is certainly a key priority right now, and I'd expect we'd have some news on that over the coming months. Offtake then becomes a key part of being able to sell this product into market. What I would say is there is an opportunity to use our Indian facility to actually do some further processing of the ore out of Madagascar, and then ultimately in mining to get this into development. This is our battery anode facility, which has been well contemplated and considered for a number of years within the company. This is in Germany, and once again there's some feasibility numbers that have been put on the ASX as per 17th of January. This will take the Maneri concentrate move it through a processing facility, and then get an output which would be perfect for the battery anode market. There is global demand for EVs. I'm a believer of that. I don't think we're going back to internal combustion, and we feel, being one of the only companies actually in production providing graphite into these markets is a real point of difference. EU, you're seeing recent announcements in the EU around the Critical Materials Supply Act and subsidy supports, and we are in very advanced discussions with the EU in terms of building our project out in Germany. And these ongoing discussions have happened within country over recent weeks. What does the scoping study say? Well, it is some robust economics there. You'll see the payback time is less than 4 years. It delivers a good IRR for our investors, and ultimately is a project that we will bring to market at the right time. Battery growth, I think a lot of you would be familiar with Benchmark Minerals. They spoke at this conference last year. There is the expected flake graphite demand year on year out to 2034, and you're seeing that some increase of 239% by 2034, led by the battery sector. Battery applications will continue to dominate, and the global graphite market is expected to grow to some 21.6 billion by 2027. In terms of battery supply, this is the demand for anode material versus the supply, and you can obviously see quite a large gap opening up there, and there's a growing disconnect in emerging between demand and supply side of anode graphite, particularly outside of China. Demand for battery-grade graphite anodes is forecast to outstrip supply by 2027, which will only widen these gaps into 2030. So this supply gap presents an opportunity for Evion and our investors to fill a critical role in the global graphite anode supply chain. Our board is a small board, but experienced across both the development and financing of a bunch of mining projects. I would pay tribute to David Round, who's unfortunately unable to be here today. He's doing an incredible job. Our chair, Heather Zampatti, who's spent her life in public markets, and Craig Lennon, who's also worked a lot in graphite, rounds out our board. In terms of why invest in this business, these are the news points which will flow in 2025. The joint venture expansion, as I said, we've funded that to double production. Those numbers will flow straight through to the bottom line. It's quite a modular plant. It's not it's not a difficult project. You just got to have the demand to actually expand, which we currently do. We have the Minieri project approvals, which go through the key milestones and working with the local community in country. We've got financing and permitting, which I've talked to about. We've got a lot of government engagement, a lot of site visits currently happening in and out of Madagascar. Off-take agreements, obviously, I'm hoping there are people in this room that will take note of what we've got in terms of future off-takes. There's a final investment decision in Minieri, and then ultimately the big project in Germany. In terms of our business, I feel we're significantly undervalued. It's $8 million market cap as of today, $2 million in a bank, with a $6 million US revenue coming out of our joint venture in certainly the next 9 to 12 months. It's a quite tight held capital structure, and like I said, if you'd like to read an independent view, please look at the Euroz Hartley's broker note, which Sophie from our team's here, and she can get you a copy at our booth. In terms of wrapping up, I just wanted to say thank you for listening. This is quite a unique story. I talked to you at the beginning of this of the importance of being flexible in business. I think the business model that Evion has developed to be ready to bring things to market at the right time, but also more importantly have cash flow to fund some of our own destiny, is a real point of difference. And if I could ask you to do one thing, is please put us on our watch list, and if I ask you to do a second thing, come and visit us at our booth. We have a booth inside here. And it's my pleasure to hand it back to you, Chrissy, and thank you for the opportunity to present.
You need to hand that to the next person. But Warwick, thank you. When you do go and have a chat with Warwick later on today, he's a very proud member of a number of boards in Western Australia. He's held in very, very high regard. He also has a secret hobby, which you can ask him about, which has thrust him onto the board of a very famous West Australian organisation as well, which is Surfing Western Australia. So he's got this fantastic broad set of interests, and that's one of them. So it's really impressive, the number of different organisations that you're a part of and that you have such a great handle on. So thank you for taking time to come here today and sharing this story with us. So go and have a chat with him at his booth and, yeah, talk about all sorts of things that come out of Western Australia. We do some interesting things down there, including giving you great opportunities for exposure to critical minerals play. And this one is going to be an interesting one, definitely worthy of your full attention. Empire Metals. So they are zeroing in on a globally significant discovery in a critical mineral that's set to disrupt more than just one industry, from what I have heard. And this very soft-looking fellow here.
That's very fine.
He's sharp. This one is very, very sharp. So, they're not talking potential. They're actually talking scale at this point in time. This is their managing director. His name is Sean Bunn. He means no nonsense, and this is going to be a really interesting talk. Please make him welcome.
Thanks, Chrissy. Thank you. Well, firstly, thanks for your attendance. I really appreciate the endurance being shown by the crowd today, so that's fantastic. And I'm pleased to be able to introduce both Empire Metals and what we call this Pitfield project. So the picture above us shows pretty well the area that we're drilling. It's largely a wheat belt part of Western Australia. So simply put, the Pitfield project is a district-scale titanium mineral deposit. Titanium, as I'll go into, is one of the critical minerals. It's actually a critical metal. It's used in aerospace, defence industries, has really high importance, for certain countries at the moment because of geopolitical risk. One of the interesting things, though, is that the best feedstock for making titanium metal is in very scarce supply. Great location, probably one of the best places to find a giant mineral system is Western Australia. It's something we're really familiar with. This project, as I describe, is scalable. It's based on conventional processing techniques, nothing terribly innovative. It's just basically cobbling together tried and proven processing methods. Got a great team, good board, great technical people based in Perth. Really happy with the team that we're assembled. And as you'll gather as I present, I hope that you'll realise that we are, as many developing, emerging explorers moving into development, we are considerably undervalued when compared to the size of the asset. So quickly on the titanium dynamics, it's quite a big market, 23 billion, much larger than lithium, much larger than rare earths. So this is a market that grows at just under 4% on average, linked to GDP. The most amount of titanium in the world is made as a pigment. Titanium dioxide, as a pigment, has no substitutes. It creates the widest and brightest of all of the pigments available. But as I said earlier, it's the metal that is of great interest, I think, to the supply side of the chain. So aerospace, Boeing, Airbus are looking for metal supply. And as I said, a lot of the defence industries, fighter jets, submarines are using it. It doesn't corrode. Titanium is as strong as steel and half the weight, so hence its applications in aerospace. Just want to explain something about the supply chain for titanium quickly. 95% of the world's titanium comes from a mineral called ilmenite. These are generally either beach sands, mineral sand deposits. Many of you would be aware of that. Also, some of the big producers like Rio are mining hard rock, igneous-sourced ilmenite, hematite / magnetites Norway and Telnus, they also have an underground processing for hard rock mining. So the industry is actually generally driven by a mineral that is extremely difficult to extract the titanium from. And as ilmenite is not suitable for making metal directly, you have to upgrade it. So you make synthetic rutile in the case of mineral sands. If you've got a hard rock, you generally have to smelt it. So these are really high energy-intensive industries. And as I explain a bit further, you'll see that this unique ore body requires neither smelting nor further high-energy conversion to get to metal. So what have we got? Pitfield is a sedimentary-hosted hydrothermal titanium deposit, which is pretty well unheard of. It covers about a strike length of 40 kilometres. It's 10 kilometres at its width, at its widest point. But we've traced this ore body into the ground about 5 kilometres. So it basically goes right down into the base of the sediments. This is brought about by hot thermal fluids coming up and bringing the titanium and dropping it into the sandstones. So the sandstones have acted like a big sponge, if you like. We've drill tested this ore body. So as recently announced, we've been putting rigs up to site. We haven't got those results, but of the 117 holes that I've drilled into this ore body, every hole from surface to the bottom of the hole is in titanium and minerals. And every metre of every drill hole is in mineralisation. The deepest hole I've drilled is over 400 metres into this ore body. So this is truly a giant. There's 1/3 of the world's known resources for titanium dioxide is measured in our exploration targets on this deposit. And as I'll explain a little bit more, we're moving towards a mineral resource estimate. If you could take a pen and put a cross on a map anywhere in the world where you'd like to find a giant mineral system, this is the place to be. We're about 60 kilometres inland from a coast. We've got rail lines already running through the licence connecting to the second biggest port in Western Australia. There's high voltage power systems running right through the middle of the tenements, and we've got a natural gas pipeline running from the northwest shelf, runs about 30 kilometres to the west of our licences. This is one of those, giant mineral systems generally don't follow any of the rules. They actually break them as they're forming. So there's nothing like this on the planet. One of the most interesting things about this deposit is the natural weathering effect of these titanium minerals. So at surface, down to about 70 to 80 metres depth, all of the titanium minerals have now been weathered and reformed as titanium dioxide minerals. So we basically have a weathered cap full of rutile and anatase, which are the most highly sought after feedstocks for going to metal. Where are we in the process? Well, we only discovered this deposit about 18 months or so ago. First drilling was done just under 2 years ago. We've been rushing forward as fast as we can. So basically in the last few months, we've taken ore samples from our drilling and been pushing it through a product development pathway. And to no great surprise, these minerals behave fairly conventionally. They're not particularly difficult to separate. So titanium minerals are very heavy, gravity works very well. What we're finding, however, because of the weathered cap, we have a certain level of clay mineral near the surface. That clay has been weathered, and from aluminum silicates and other elements in the fresher rock. That's basically formed kaolinite. Now, kaolinite is what you make china from. It's China clay. The China clay industry for the last 100 years has been separating minor amounts of titanium minerals from the clay because they are actually an impurity to the clay that they want. So the conventional technique for doing that is flotation. We've already tested our kaolinite, if you like, at surface, and we've shown that we can recover the titanium-bearing minerals from that as well. So unlike a mineral sands deposit, we don't throw anything away. 100% of the ore goes through our processing. So what is the flow sheet going to look like? We're going to target this top weathered cap as an initial plan. We've got about 5 billion tonnes in our exploration target, so that's something like 400 years of mining. So we're going to focus solely on the weathered cap for the time being. It's free digging, there's no blasting, there's no waste to remove. It doesn't require crushing or grinding, so it'll go straight to a wet scrubber. We'll separate the fines, the clays, simply by a desliming process. The clays will go through a flotation circuit. The coarser material goes through basic gravity spirals. We've already tested this at bench scale. We've made a concentrate. That concentrate isn't particularly refractory. It responds to acid digestion very well. We were able to dissolve upwards of 90% of the titanium from that concentrate. So basically what we've got here is a fully integrated process. You know, a very low-cost mining option, straight through scrubbing, make a concentrate, digest that, and what we're bringing out of this process is a pigment-type titanium dioxide product that we can also go and produce metal or feed the metal suppliers. So 2024 was a huge year for us, there's no doubt. Made the discovery, tried to work out what we had, realised the scale of this. 2025 is going to be even a better year. So we're going back with the drill rigs, we're going back to drill out the resources, bring this into a mineral resource estimate. We're out there producing product, we're going to increase the scale of our test work. We've already got 50 tonne of bulk metallurgical samples coming down from site. So instead of doing batch test work, we're scaling up to 1 or 2 tonne scale gravity and leaching circuits. And we're going to make several hundred kilos of product in the next few months and get out to the industry. Literally go out and start talking to the end users. Quick look at what our capital structure looks like. So at the moment, our market cap, well, we're listed in London, so our market cap's sitting just under about 80 million pounds at the moment, so just over 100 million US. We're also now trading on the OTC in the US, so we've only been doing that for the last few weeks. We're already starting to see some trade that's looking really promising that will get a lot more US investors into the company. So at the moment, we've also reasonably well cashed up. The last announcement we made on our finances, we had 4.8 million pounds in cash ready to pay for the work program. So the runway, if you like, is pretty clear. It's pretty open for us. We can go through all of 2025 and drill out the resource, finish the test work, and move into the next phase. I mentioned earlier the board. We're pretty well spread. This is really an international effort. Our chairman and non-exec chairman, Dr. Neil O'Brien's a geoscientist based in Toronto. He was the senior vice president for London for many, many years. He sort of retired from that, but still consults back to the London group. Recently, we announced the appointment of a Phil Bromett, who's a mining engineer. He came out of Freeport, Newmont Corp. So he's basically a big mining picture sort of guy. Really pleased that he was able to join the board in January. The rest of the team, Greg Kunzel, our CFO, who couldn't be here for this particular conference, he was one of the founding directors. So he's been with the company now for about 15 years, taking it through to this stage of development. So basically, I guess I just want to finish by saying, what do we see, I guess, for the future of something like this project? Importantly, it's completely different from whatever has been found in the titanium industry before. So you've got an industry that relies predominantly on a rock called ilmenite or a mineral called ilmenite. That particular mineral requires intensive high energy to get it to a form that you can make the metal from or make a pigment from. This project doesn't have that particular problem. The other thing about our products is that it's almost completely free of the major contaminants that the industry have to deal with. So there's no uranium and no thorium in our product. There's no chrome, there's no heavy metals, there's no phosphorus coming out in the product. And there's a simple reason for this. It's not because we're particularly clever at processing. The reason is because there's none of those elements in the ground. This is a sandstone. It's basically quartz, hematite, some kaolinite, and the rest of it is titanium. So, great project, biggest thing on the planet, fantastic location, basically has everything in front of it in terms of being the biggest disruptor to the titanium industry. And I look forward to coming back over the next 12 months, possibly even coming back here if the opportunity presents itself to start talking about how we're going to bring this into commercial realisation. Thank you.
Well done, Sean. I said it was going to be interesting at the start, didn't we not? All right, we're down to our final few presentations, and those of you who have chosen to be in the room for this session are going to be rewarded yet again with the next one, because on stage is coming a company that is fast becoming a cornerstone in the global battery materials supply chain, vertically integrated, strategically positioned, and with government backing to boot. Sounds like a nice little trifecta. This is their Managing Director of Renascor Resources. Would you please welcome David Christensen?
Thanks, Chrissy. So, Renascor Resources, we're a Australian exploration and development company, and we made the move into the critical mineral space after we discovered have now been developing what's turned into one of the world's largest graphite resources in our home state of South Australia. Our plan at Renascor is to produce not just a mine graphite product, but we want to lean on the technological engineering expertise of the Australian mining industry to move one step further and refine that into a high purity product that we can deliver directly to the lithium-ion battery industry. As a mining asset, we think we have one of the premier assets, not just in Australia, but in the world in the graphite space, with a competitive operating cost, capital intensity. But because we're located in Australia, we have both the mining infrastructure and the industrial infrastructure to allow us to move further downstream. And we think we're relatively unique in actually being more competitive by moving downstream and producing a refined product that we can sell into the anode sector. And we think it gives us a chance as ex-China markets start to develop and open up to become one of, if not the largest, producers of this product ex-China. A few words on the market. I think graphite is becoming a battery mineral, and we look to EV and lithium-ion battery growth for the future of the battery sector and of graphite in particular. One thing I wanted to call your attention to is where we are in the cycle. So we're at a relatively early point in the transition to electric vehicles, and I think you've seen some of these charts we show on the right of this slide. But I think we've passed the point of no return. That's certainly how we feel, that batteries themselves are becoming efficient. Those of us who have been going to these conferences for several years remember when we talked about the theoretical value of 100 US per ton kilowatt hour for batteries, that we've now blown through that. And this is the kind of growth that can outlast the political and commodity cycles we're seeing right now. And we're certainly seeing that. If we look at what happened in 2024, there were a lot of headwinds impacting the sector, and it certainly impacted the valuation of critical mineral companies like Renascor on a number of different fronts, whether it's inflation, which is decreased buying power, or some of the geopolitical uncertainty which has inhibited capital investment decisions. And again, this has really hit us in Australia. But then the prevailing theme, I think, is the Chinese domination. And the impact on this is it impacts the competitiveness of really any non-Chinese project. But despite all these headwinds, EV sales actually increased, uneven growth, but increased in 2024. And I think 2025 looks similar. So again, we've passed the point of no return. Now, what does this mean for graphite? Well, in graphite in particular, we're not only seeing Chinese domination, we're seeing near monopoly control by the Chinese. And so we're still looking at just less than 2/3 of all the electric vehicles are made ex-China, but they're almost 100% dependent on the Chinese now. And this is a problem, and this is the gap that we think we can fill. In particular with graphite, every different mineral has its own story for Chinese domination, it seems. With graphite, what the Chinese have done is they've really doubled down on their investments on synthetic graphite by investing in excess capacity. We don't think this is sustainable, nor do we think it's replicable outside of China. And we're already seeing the signs that it's starting to break in China. With Chinese suppliers are operating, I think most people in the sector would agree, relatively below cost. This has led to some noteworthy defaults from some of the major anode companies in China. And we've already seen the beginning of this year, the feedstock going up. But maybe more to the point, this isn't replicable outside of China. And that's largely based on the capital intensity and energy intensity of synthetic graphite production. So in 2024, not a good year for anode companies generally. The proportion of natural graphite anodes produced ex-China by the two main markets, South Korea and Japan, actually increased. So moving forward, we're expecting to see a significant increase in demand for natural flake anodes, in particular in the ex-China market. Price is holding us back right now. So in 2023, graphite prices were high, almost double what they are right now. And this would green light projects like ours. But since 2023, we've seen a gradual decline and then leveling off on prices. But in the meantime, we've seen graphite equities go down even further. And you can see from the chart here, you sort of a breakaway where graphite prices are flattening or even increasing in some instances, but graphite equity prices start to go down. So to us, this looks like, have we reached the bottom of the cycle? Is this an opportunity for investors to come in? It is if the graphite prices return. So what's going to make the graphite prices return? Well, part of it depends on what the Chinese do. We have no control over that. The ex-China market is talking about public policy initiatives, whether it's out of the U.S. in some of the America First initiatives or tariffs coming out of the U.S. or EU. Could that create an ex-China price? Maybe. Could it also happen with China? China's talked about export restrictions on graphite before. Any of these changes could turn around the graphite price instantly. We could get very quickly back to where we were in 2023. The main players, though, aren't waiting for the market to change. They're moving ahead. And so if we consider the anode market, again, this is our target customer base, ex-China anode production. In 2024, 6 companies accounted for 97% of ex-China anode purchases. 6 companies. China, Japan, and Korea accounted for all of this, and they're already moving forward. So the legacy South Korean and Japanese suppliers are leveraging off their initial existing capacity to expand. And even some of the Chinese are moving offshore into Indonesia and Shanghai. And really the underlying driver of all of this is to create ex-China supply chains that are going to need the kind of graphite that we want to produce at Renascor. So a little bit about our project again, where we're vertically integrated. And again, we try to illustrate with this cartoon what that means is basically we're going to have 2 operations. We'll have a mining operation, and then we'll have a secondary obligation that refines that. The mining operation is based on our Sivir graphite deposit. It's a large graphite deposit. It is the second largest proven reserve of graphite globally, the largest reported reserve out of Africa. So it's a big graphite ore body. But in addition to being big, we think we can produce a material at amongst the lowest operating costs with amongst the lowest capital intensity of any graphite project outside of China. And we're development ready. We've cleared most of our major developmental hurdles. We have all of our regulatory approvals in place. We've completed a definitive feasibility study. We've acquired our land. And we have a strong cash position. We have over $100 million as of the end of 31 December 2024. We have $185 million conditional loan facility from the Australian government's critical mineral facility. We've actually moved beyond traditional FID work to move into more detailed engineering and long lead time procurement. But we think we offer more than simply being a mining operation by moving downstream. And by producing purified spherical graphite, it transforms Renascor into a vertically integrated battery materials company. And why does that matter? Well, for one thing, it gives us market access. Instead of selling our graphite to intermediate refiners, most of whom are in China, we can sell directly to big balance sheet bankable anode companies. We also think it gives us an opportunity to, again, utilize the Australian mining sector to deliver a better refining solution. And we think we have that in a purification technology that we've been working on for a number of years now. Finally, the vertical integration strategy also allows us to get better returns for Renascor, better returns for our shareholders. And again, we think this gives us an opportunity to become competitive. We can be amongst the lowest cost producers of a graphite flake at the mine. If we move further downstream, we think we have an opportunity to become amongst the lowest producers ex-China. What does that comparative advantage mean, and how does that work? Well, I guess we think that our vertically integrated model allows us to achieve a number of efficiencies. One is on feedstock. The single largest component cost in the production of purified spherical graphite is the graphite concentrate feedstock itself. If we can produce at our projected cost, that gives us an advantage. There's a logistical advantage by producing in-country. We'll be producing along the existing transport corridor, so we'll save money on logistics. We'll save money on transport and material handling. Sovereign risk. Most of the lower cost graphite developments globally outside of China are in Africa. We have the benefit of being in Australia, which has both the mining base and the industrial base to allow for the greater investment in the downstream. And then finally, technology and engineering. So for about 5 years now, we've been trying to develop what we think is the most cost-competitive technology to purify graphite so we can deliver it to the anode sector. And we think we've done it. So the Chinese generally use hydrofluoric acid, which works quite well. We've been developing for a number of years an alternative technology that uses a caustic roast and sulfuric acid in a leach process. What we found is it's not very difficult to reach battery grade. In fact, you can do that in any different number of methods. The hard part is doing it efficiently. And so what we've been doing is we've been trying to engineer a good way to do that inexpensively, and we think we have it. By using this method, we think it's just more efficient in a first world environment because we avoid some of the high costs for transporting, for handling, for disposing of hydrofluoric acid. We recycle our reagents and we treat our processed water, and that leads to lower reagent costs, lower water consumption. We were recently granted a $5 million co-funded grant by the Australian government. We're building a demonstration facility. If we're successful with that, we think this gives us really another potential competitive advantage in just having a lower cost way to purify graphite. As we move through in the next couple of months, we're staying quite busy. We have an early contractor involvement that's maturing the engineering design. That will lead to a preferred EPC contractor. We've done a significant number of long lead time procurement items. Probably the biggest one is we are close to finalizing the connection of the electricity grid to the mine site. We're expecting to commission our demonstration facility later this year. We're also working on a very long process going through the approvals for our commercial scale downstream. We think we're relatively close to getting that as well. On the offtake and financing side, we have a conditional loan facility from the Australian government. And I guess our strategy on offtake is trying to work with the major anode companies. We have non-binding agreements in place with, amongst others, POSCO and Mitsubishi Chemical, who are two of the larger anode producers ex-China. We really think that the most economically viable solution ex-China to producing anodes is going to be a combination of companies like us who can produce the purified spherical graphite at a low cost with existing anode makers. And we think that's going to allow us to unlock the greatest value for the sector. As we move forward through the rest of the calendar year, we expect to be busy and have a number of material announcements on our ECI process, on the engineering. We think we're relatively close to getting our regulatory approvals on our downstream facility. We'll be commissioning that demonstration facility as well. Concurrently, we're working on trying to finalize binding offtake agreements with anode companies, and that would allow us then to move forward, secure financing and strategic partnership agreements, and then that gets to a final investment decision. So again, our plan at Renascor is to work as quickly as we can to accelerate both that upstream and downstream together. We think we're competitive on the upstream with anything outside of China. By moving one step further downstream, we think we can be even more competitive. Now, we don't expect to be able to compete with the Chinese on refining, but the way the market's going, we think that the competition is going to be everyone outside of China. And here we think we have an opportunity to do something that's even more competitive, and that'll allow us to grow into one of, if not the largest provider of this product globally. Thank you very much.
Well done, thank you. Now, earlier today we learned about the investment opportunities presented by Vanadium. About 10:15 this morning. It was an intimate little fireside chat, and we had Terry Pearls, who was president or is president of the TTP Squared LLC. It was facilitated by Tribeca, and now it's time for this gentleman to shine brightly all on his own and put the spotlight firmly on the company that he is CEO of. So here to extol the virtues of Australian Vanadium, would you welcome back to the stage for one performance only, as it were, Graham Ardison. Graham, welcome. Please make him welcome, everyone.
Thank you, and thanks for having me. I'm going to start by asking a few questions that I'd hope you keep in your mind as I move through this. My usual hook for everyone to think about investment is why vanadium, and I think specifically to this conference, the upstream side of our story is of interest to everyone. Why vanadium? Why Australian Vanadium AVL, and why now? And I'd also then add one last question, which rolls up all three of those, which is why long duration energy storage? And by answering that question, the other three should solve themselves by the time I'm done this presentation. And that's what I'm most excited about, and why I hope it is a fitting scenario of, as a Canadian, doing something which is skating to where the puck is going to be, which is long duration energy storage. And Scott Clement's opening comments this morning of finding companies at this wonderful conference that may one day become a 10-bagger, please listen up and think through those questions, because long duration energy storage is a new market segment. Vanadium flow batteries are an absolutely proven commercialized technology being deployed in China at many gigawatt-hour scale. And that new market is incredibly massive. Just in Australia alone, there's an addressable market for all the vanadium that could be produced in Australia alone, let alone the rest of the world. So let's get into it. Please read the disclaimer in your own time. Vanadium 101, you're probably wondering at a critical metals conference, why AVL, why now? Because the vanadium price is at a 10-year low. If you heard Terry and myself talk about it this morning, you'd probably conclude that that's going to change. The two key thematics to think in mind are the historical use case of vanadium has been in decline, that is used as a steel alloy, and the dominant driver of that is very simply rebar in China in buildings. And I think the last 3 years have been self-explanatory there, and that demand case has dropped over 30%. However, the hockey stick moment has arrived. At the same time and across the same time period, use of vanadium in batteries has gone from 1% of the market to now 15% of the market, and that is projected to become a full battery metal in the not too distant future. There's Terry's analysis there, which is 37%, and I'd like to make a case to you today why I think that can happen very much quicker than that, and vanadium becomes a battery metal before we know it. At Australian Vanadium, we have an integrated supply chain solution, and today I'm going to end the story with our upstream, which is a Tier 1 asset in the Midwest of WA. And I want to frame it in why the downstream aspect of our business is so critical and so important and high value add, and it's the why now part of our equation, and how it ultimately will absolutely unlock the strategic advantage and competitive advantage of having an integrated upstream aspect. Why long duration storage? I think in some ways it's an easy answer, but ultimately, if we're going to go on the renewables journey, which we are inexorably committed to in places like Australia, we must move from 2-hour batteries and 3-hour batteries to longer duration and technologies that are economic at those longer durations, and that is vanadium flow batteries. AEMO is the Australian markets forecaster, and there are jurisdictions around the world that look a lot like this. But even if we assume that all of the long duration that can be addressed maybe by pumped hydro, which in my opinion is probably not going to happen, it still leaves a massive addressable market just in Australia. That is some 7 gigawatt hours per year of long duration storage, where vanadium flow batteries are highly cost competitive and bring a bunch of other opportunities to the table. And that 7 gigawatt hours, to put it in perspective, an upstream asset like ours would be slated to produce about 1.2 gigawatt hours per year of vanadium. There is a battery now announced for Western Australia, which is a 500 megawatt hour battery that will be the largest flow battery outside of China. It's slated to be built soon, and that would comprise some 2% of the current global vanadium supply. So I need to frame this in gigawatt hours because that is the end market, and the why long duration storage question is important, but the conclusion is huge addressable market, and now I'd like to show you why flow batteries are going to play a role there. Flow batteries are proven. I'll get to the next slide, which is how many gigawatt hours are deployed. There is no longer a question of technical risk at these utility scale batteries, and it's really coming down to economics. And I'm an economist. This is where I get excited. Vanadium flow batteries have this curious nature where the longer the duration is, the more cost competitive they become. And depending who you talk to, the crossover may be 4 hours, it might be 6 hours. But the reality is the energy market is now pricing in places like Australia 8-hour batteries, and that is where this becomes compelling. And then when you're cost competitive, you bring all these really elegant solutions to the table, which is that it's a non-flammable technology. You can easily augment the duration, which is a really big superpower of the battery. If you want to go into the market with a 4-hour battery and get the revenue then, 2 hours later, augment to 6 hours. This battery is super easy and low cost to do that. Lithium literally cannot do that. And as we move into the longer durations, we start eating the lunch of pumped hydro, which those who follow the energy sector in Australia will probably know is not going that well. And ultimately in jurisdictions like Australia, there just aren't that many pumped hydro opportunities. The last but not least thing, which is going to become prevalent in Australia, is local content does matter, and vanadium batteries, without trying too hard, you can get to 70% local content, and you can certainly move up from there. And our competitors bringing lithium ion into those large-scale lithium battery space are going to struggle to probably get above 20%. And if you look at the procurement mechanisms and the capacity investment schemes and the other ways that these batteries get revenue, it's becoming increasingly important to have local content in these jurisdictions. The other aspect of vanadium that's worth considering is the batteries will last 30 years under warranty with virtually no degradation. Our models suggest they'll last 50 or even 100 years with a bit of maintenance, but ultimately you have longevity without duration, and that is really driving a great outcome on the economic front. Here's China and what they're doing broadly. This is happening outside of China, but not at that scale. And coming back to the West Australian story, this is the dam breaking moment. And the battery being built there is only one step below the biggest one in the world, which is massive, 500 megawatt hours. China's not only deploying over 100 utility scale batteries right now, they are also building 35 gigawatt hours of vanadium flow battery manufacturing capacity. If you want to bring it back to the commodity side, that is a staggering amount of vanadium. The leading manufacturer in the world, Ronca Power, out of Dalian, this year they will grid connect 3 gigawatt hours of vanadium flow battery. But even more interesting to me, they will reach 3.5 gigawatt hour per annum production base. And that is some 15% of the global vanadium supply in one manufacturer. So pay attention to the commodity side of the story as well. Here's our story. We are focused in terms of our integrated chain on Australia, and I think a lot of our commodity producers, we focus on international jurisdictions simply because of addressable market size. Actually, in Australia, our addressable market is more than enough, and we are pursuing projects, not just the Kalgoorlie battery opportunity in Western Australia, but projects on the East Coast, because the nature of the electrical network there is they're already pricing in 8-hour mechanisms. It's really interesting, and the batteries being proposed there are already bigger than what's slated in Western Australia. So here's Project Lumina, and it's probably not common and typical that someone developing a Tier 1 asset in Western Australia is also developing a really elegant, strong IP point, which is an off-the-shelf, scalable, turnkey Australian solution for what they're already doing in China. That is full design, full costing, full detailed ready, that we can deploy hundreds of megawatt hour capacity. This is a 500 megawatt hour battery, and Project Lumina, by the middle of the year, will have all of that work done. And for us, that's first mover advantage. And for us, that is also cost competitiveness advantage. We believe we're the only company in Australia, probably the world, who's looked at how to really cost effectively and with certainty, where a bank can go in a data room, deploy a large-scale vanadium flow battery. We're also established electrolyte producers in Western Australia. Last year we built, designed, commissioned, and now operating an electrolyte facility. And a big milestone for us is we've successfully deployed that in a battery with Horizon Power, a leading utility in Western Australia. So we have the midstream, we have Project Lumina nearing completion, and we've committed to make FID ready our downstream Project Lumina capability readily deployable into opportunities like Kalgoorlie, which has 150 million of state funding attached to it. Just a pretty picture, but this is way more important than we anticipated and is going to become more important. The ability to augment and move with the energy market as it changes its pricing mechanisms is critical. Yesterday I was in Seoul speaking on a panel with a bunch of very large lithium-ion developers, and they emphatically said they cannot do this, they cannot augment. And this is brilliant because if you want to deploy capital at 4 hours on year 1 and put a 6-hour battery in at year 5, very simple, very low cost, very elegant. You just add a few tanks and you fill it with electrolyte. So it's a little bit technical, but this is actually really critical to why these will be adopted, not just for their cost effectiveness, but for their ability to get more revenue as a battery asset. Here's what a battery development would look like. So again, the upstream has its own timelines and FID basis, but do think about this if we land one of these projects and how we would finance it. Ultimately, it's about a 2-year process to revenue. So we're trying to help our investors understand we are very close to that starting point, the starting gate. We're catalyst rich around how we partner and achieve these large-scale projects. And ultimately, what then it follows is critical path-wise grid connection process. And all of our competitors in the energy storage development space would have a very similar timeline where we're working through approvals. Again, if we were to build the Kalgoorlie battery, it's important to note that's about 2% of the global vanadium supply. And if we go out and procure that oxide right now, it actually tightens even an oversupplied market and will actually change the price. That's one single battery outside of China. So in lockstep, what we're trying to do as a company is make sure we're ready with a really good asset in a really good jurisdiction, which is a large-scale, high-grade, low operating cost vanadium oxide production capability. That's in the Midwest. Last year we completed a merger which makes one of the largest, highest grade vanadium developments in the world, and I think we are the most advanced in terms of permitting of new primary assets in an ideal jurisdiction. So keep an eye on that. We are moving forward with the optimized feasibility study, which is to combine the best project from the merged companies. And there are catalysts there that people may not pay attention to because of the lower vanadium price right now. But I hope it's clear today that if you believe in the long duration storage thematic and you understand how competitive and how compelling vanadium flow batteries are and that they're proven, the vanadium price will follow, and us being ready is super important. On the other milestones, do keep an eye. What are the catalysts coming up on the upstream tier 1 asset basis? That is, we are at the pointy end of approvals, so keep an eye on really the 2 assets that we're developing. Our mine south of Meekatharra is crystallizing our final EPA approval. We have received our major EPA approval in January, and we're now part of the Green Energy Major Projects, part of WA. In terms of government support, please also note, I think it's telling, the government changed the royalty as an election commitment, that if we go to electrolyte, the royalty is now 0%, and vanadium oxide's 2.5%. That is, I think, very telling in terms of the state level support for this major project. We're also permitting a processing plant east of Geraldton, which is mostly permitted and near the finishing line, so keep an eye out for big catalysts there. In summary, why long duration storage? It's inevitable. It's a huge addressable market in Australia alone. Why vanadium? Well, flow batteries are an absolutely proven tech. They're being deployed at eye-watering scale in China. And even if China did it alone, let alone what we're going to do in Australia, that is going to change very soon in terms of that steel thematic being superseded by a battery thematic. So do keep an eye on the commodity piece there. Why Australian vanadium? We have competitive advantage at every point in our value chain right now. We are first movers. We have a tier 1 asset ready to go in the next 12 to 18 months. We have the midstream established, proven capability with electrolyte deployed into operating batteries. And in the downstream, by Q3, we intend to be FID ready on a large-scale utility-scale project. Why now? The state government of Western Australia wants this to happen. We can bring that solution to them. Keep an eye on us. It's happening now. Thank you.
Well done. Brilliant, absolutely brilliant. We've got in Perth, Western Australia, we have this thing, a supercomputer, and I know there's a couple of hundred of them around the world, but I did a story on it recently for an innovation TV program I do, and it actually sucks up the energy every day that the suburb in Joondalup in Western Australia, which is 285,000 people. So it uses the same amount of power, the same amount of water as 285,000 people do every single day to do its computations to help us live a better life. And we're going to add more supercomputers. We need more power. We need storage like that. All right, all day long, we have heard about potential, haven't we? And this next story, this one might just be the one you think, well, gee, I'm glad I stayed in my seat. I'm going to be talking about this at drinks tonight, which are being sponsored by Intertech. And who else have we got sponsoring our drinks this evening, Shaz? Just let me double check that one. We've got 2 sponsors tonight. Now I've opened my mouth, I should actually mention them both, shouldn't I? Oh, we've got Aaron from Hall Chadwick, and Aaron is going to be in the hall to have a chat with us. So we've got drinks tonight. You're going to want to talk about this presentation at Drinks, I know, and let me tell you why. They've got a fresh focus, they've got a bold strategy, they're in a tier 1 mining jurisdiction, they've got a wide spread of exposure, so think uranium, copper, lithium, more. So this is a company that is built to ride global megatrends, multiple global megatrends, and this is the man that's going to tell us all about it. Managing Director of White Cliffs Minerals, this is Troy Whitaker. Please make him welcome.
Thanks, Chrissy. Can you hear me? Yep. So just before we move on, my name's Roderick McElroy. I'm actually the chairman. Troy was called away to deal with some... Yeah, sorry, it's my fault.
Wait, before you go anywhere. Do you know, I have pictures of everyone on my little list down there, and I don't have a picture of yourself, so you're the one person that is...
I snuck through.
So it's lovely to meet you properly.
Nice to
My
meet you.
apologies for not seeing you before.
Thank you.
Please welcome, right, everyone.
Best till last, best till last. So as I was saying, I'm the chairman of White Cliff. I work with a team of professionals that's been together for about 25 years. Most of that has been in the Arctic. We have sort of always had a philosophy that to find the next big mines, you need to go to where people haven't been before, or there is less activity. I'm a School of Mines boy. I spent 10 years working in the gold mines of Western Australia, and one thing that really struck me was the idea and the application of statistics in mineral exploration. And one of the things that became very apparent working in the West Australian goldfields was that you're walking over ground that several other previous operators have been through in previous generations or decades or whatever it might be. And we took a slightly different philosophy and started looking at more frontier locations, levering off historical data sets that state-sponsored surveys, let's say Calgary Mines Department might have sort of done work through this part of the world. And that philosophy has actually been very successful over the last 20 years with the team and myself. We're sort of living on that sort of leading edge of exploration. We've made some major discoveries inside that sort of circumpolar region. We are one of, if not probably, certainly sort of 1 or 2 or top 3 best cold climate exploration teams that's around at the moment. We have developed and discovered major projects as close as sort of 800 metres to 800 kilometres to the North Pole in the northern part of Greenland. Some of the largest deposit of uranium on the planet was also discovered on the southern tip and developed by us. And we've sort of taken this team and this philosophy and we sort of headed into northern Canada, again sort of levering off. I'm not going to give you third-degree PowerPoint burn because I was caught, as I said, I'm called in at the last minute, so I'm sort of half making this up as I go. But what we identified here, or what as one of our partners spent a lot of time reading old mining reports. These two projects, Great Bear, this is the very northern part of Nunavut, and the Ray project, were projects that were discovered many, many decades ago. In actual fact, Port Radium and the Echo Silver Mine were mines in the 1940s, 1950s. And for whatever reason, these projects were sort of, I guess, boxed up, non-digitised. They were all in paper form at the back of a very large sort of underground bunker in the Calgary Mines Department. And some of the results that we identified with these projects were truly just astounding. So we're going to focus on the Ray Copper project to start with. We'll quickly pass through the Great Bear as we go. But this is a project that has extraordinary outcropping occurrences of copper. And most importantly here, the reason that these grades are so high, and you can sort of see vision, 64%, these were all spot occurrences, rock chip samples by the mines departments, that in many instances we've gone in and extended or given those occurrences material strike lengths. So what was a single point on a map is now 600 metres up to 2.2 kilometres of this type of outcropping, very high-grade copper mineralisation. So what's going on here is a little bit of a geological story. This is one part, so there's the North Atlantic Rift. We all sort of know what that is. That bounds Norway and Greenland. There were failed arms to that rift that went up through this part of the world and actually sort of started to separate those northern islands from the mainland of Canada. They were then, that rift sort of became extinct, if you like, and then the new rift opened up between Greenland and Canada and started separating that, ultimately settled in its current day in between Greenland and Norway. But the net effect of that early stage rifting means that this part of the world was subjected to very deep plumbing. These cracks at the Earth's surface essentially tap the mantle. And this is a sort of what has occurred here is a conduit for very metal-rich fluids to reach the surface. And if they find the right environment, i.e. reactive rocks, you can get very large precipitation of these metals into the country rocks. And this is really what's happened here. There's two geological models. There's the vertical, high-grade, super high-grade chalcocite bornite veins, and then where those rifts, the blue line you can see heading up into the big red blob, that's the start of a sedimentary basin. And we acquired these licenses through applications late 2023, and we were the first in the region, and subsequent to this entire area is now pegged because of the results that we've subsequently put out. There is the vertical component, which is your Thor, your Rocket, your Vision, your Stark, which, variable, but anywhere between as I said, a couple of hundred metres all the way up to 14 kilometres long, 2.2 kilometres wide, and stands out on geophysics quite distinctly. So the intersection of that vertical with the horizontal, which is the sedimentary reactive rocks, has led to the identification of what we're calling Hulk, that big amoeboid red at the top. That is, give or take, 200 square kilometres. So that red blob is probably 1.5, 1.7 times the main part of the Zambian copper belt. And this is a relatively new phenomenon. This area was first discovered by early explorers in the 1700s when they encountered Inuits that had copper tools and copper trinkets and sort of tradable items out of native copper. It went through a massive boom in the sort of early to mid 1800s, but logistically and climate-wise, it was impossible to push the project forward. What's happening in this part of the world, believe it or not, is sort of this, I guess, concept of climate change. It is definitely warming in this part of the world, and this is giving us more access, longer periods of time for our activity. We are drilling this at the moment. We have a drill rig sitting on Danvers, which is an existing resource that was drilled out in the 1960s. We purchased that actually at a very cheap price early on in the process when there was little interest in this part of the world. We're drilling that at the moment. We will then be moving on to the Hulk, the big red one, and then ultimately the big blue one. You can sort of all relax because we're fully funded. I'm not here to ask you for anything or to try and raise any money. This is actually happening irrespective of what sort of transpires at this conference. But we are trying to raise the profile of the company just because I think, again, one of these very large discoveries is about to be made in this part of the world. Again, this is just sort of continuations of these various rock chip programs. Last year, I think we did something in the vicinity of 6,000 linear kilometres of aerial geophysical surveys, latest technology. It works in this part of the world for two reasons. One is that the mineralisation is obvious and outcropping. The second one is that the overall area is sort of almost void of any other false positives. There's no graphitic schists, there's no carbonaceous shales, there's no salt water plumes that can interfere with the geophysical responses. So our confidence level here is very, very high. I can't tell you how thick or how deep it will be, but suffice it to say, if you can trace 60% veins over 2.5 kilometres that vary between 2 and 15 metres width, that they have to have some sort of substance to them. So in terms of location, and this is one thing that we learnt very early on in Greenland, was that your degree of difficulty becomes orders of magnitude more difficult the further away you get from a population centre. And one of the things that you learn by doing in that situation is you really need to take everything with you, because if you're missing a screwdriver or a water filter or a knife and a fork, to get it in there a second time probably costs 3 times as much as what it would have done to get it in the first time, in downtime, lost productivity, etc., etc. We're very fortunate. There's a town here. This is the town of Kuklatuk. This is right on the Northwest Passage that's opening up now. I'll just go back so that you can sort of put this into perspective. Kuklatuk's up there. Greenland's just on the other side of those islands, and this is where the cruise ships all come through here now. This has got free water for the best part of 4 months of the year, expanding by minutes and hours every year, continuing to get warmer. So that's very helpful. That's serviced out of Yellowknife. We're about an hour and a half north of Yellowknife to that airport on a Dash 7. One of the other things that's very important in this part of the world as well is, sorry, I might have bouncing around here a bit, having landing strips on your project areas, because these are remote locations. You don't have any support network here. You have to be completely self-sufficient in this part of the world. So it means taking your own food, your consumables, your fuel, everything. And fortunately for us, and this is one thing that's great about northern Canada, is because of the, what would you call them, the hunters, the fishermen, the trekkers, the people that would be sort of, taking holidays and going for walks, there is landing strips all over North Canada. And the benefit to us, because the Kuklatuk airport, but there's one actually at the base of the Arrow where the Ray project actually sits, that is, I think it's about 1,500 metres long, capable of handling a Dash 8 cargo plane. And that is where we have based our operation for the drill program that's underway there at the moment. So having just those little benefits, those little logistical benefits in this part of the world make all the difference in terms of overall cost. Drilling 4,000 metres there, it's well underway. We are happy with what we're seeing at the moment coming out of the holes. I think there's going to be more of it. The geophysics, again, you can sort of look this up at your leisure. I know everybody's suffering from PowerPoint burn at the moment, but what's interesting here, and this is one of the conversations that really geophysics can, people can live and die by this stuff pretty easy. But one of the more interesting things about this particular method was that it was able to trace conductive material that was parallel to the bedding plane that was dipping to the north. Now what that means is somewhere in that sedimentary sequence is a conductor that we know isn't a false positive. So that actually inspired our geophysicists. They don't normally buy shares, but that particular one on the top left, if you sort of squint at it in a certain direction, that appears to be a metal-bearing ore body that is parallel to the plane of the sediments. Again, you know, just super high grades. This area is actually quite interesting. This is probably the one in my mind that's the most attractive. We have high-grade veins, 60% that might be a couple of 100 metres to a couple of kilometres long. They will be of very limited tonnes in the bigger picture of things. Hulk is probably going to be a multi-billion tonne. You know, I should preface that by saying this is my opinion only, but if it is something, it's going to be a multi-billion tonne outcome at the end of the day. Whereas Stark is actually something that's situated, I mentioned before, on that feeder rift, that main structural zone that all those fluids have gone into the sedimentary basin and precipitated. Well, this is where they came from, down there. So this is, give or take, probably in its entirety, the best part of 22 kilometres long. It's a couple of kilometres wide, and it should have some depth. The only unknown on this is the grade, because this is subsurface, but analogies can be drawn from, where are we? Analogies can be drawn from vision, which is all part of the same structural corridor up there, and further south, you know, further to the south, you're getting 65% copper. And you get to our point in life, and I know sort of rock chips can be all things to all people, but when we do this, we want to make sure that we're not wasting our time, because we've got better things to do than sort of make up results. So we were very careful and spent a lot of time and effort making sure that these results are actually representative of what's occurring at the spatial level on the surface. These aren't just cherry-picked what we were hoping to be the highest grades. So I'm running out of time, but we have a Great Bear project. This is another thing that we pegged at the same time, found in the boxes of the mines department. Historical production, uranium, 1940s to 1950s. It was a Department of Defence mine. It's produced 35,000 ounces of silver. Again, we didn't pay anything for either of these projects. We put applications on them, thereby creating a value situation where existing shareholders benefited rather than a third party. Management and the operational team, we own, give or take, 20%, most of which has been bought on market as we've truthed all of these things, and I know you're coming towards me, but yeah, I mean, you can sort of certainly look at this in your own time. But this is getting drilled now, and it's certainly going to be one to watch, I think. So, thank you.
Well done. Well done. And my apologies for not getting the name right at
That's
the start.
okay.
See those four men over there, though? They want to give them the
They're going to take me away,
They're
aren't
more
they?
scary than me, so give them that clicker there. All right, team, that is our final company presentation for you, for your investment interest. Now it is time for our final fireside chat of the day, and what a day it has been. We've heard big ideas, we've heard bold plays, and now we're closing out our conversation, come on over here boys, with a conversation that cuts to the core, investing in decarbonisation. Got to watch you, see people, okay? Because in this space, really, when we think about it, and I was just having a chat with a friend of mine earlier, timing is everything, and if you're not reading the cycle right, then you are missing the upside. So how do we discover that? John Stover, Tribeca Investment Partners, you're in charge of this panel. Do you want to introduce everyone individually? Good on you.
Thanks, Chrissy.
Would you welcome John, please, everyone? He's going to facilitate this, and then I'll cut back to you at the very end. Welcome, John.
Great, thanks so much. So I'm John Stover. I'm a portfolio manager at Tribeca. I run the Asia Credit Fund. And I know we're sort of between everyone and some drinks later, but we have a great panel here. And we're going to talk about, obviously, decarbonization and where we are in the cycle now, where we've come, and where we're potentially heading. So As I mentioned, we have a number of really strong panelists. We have Jack Rice from BHP Ventures, Michael Bentley from MST, and YJ Lee from Arcane Capital. And what I'd like to do is just start off with each panelist to sort of discuss, where we've come in the past couple of years. Obviously, the decarbonization theme has changed dramatically from 2 years ago. Scott touched on this in his keynote earlier this morning. But how has the landscape changed for decarbonization investing? How have you navigated it? And how has your approach changed? And obviously we've heard from a lot of the companies today, but these are investors and people covering it from a research standpoint. So I think that's a really interesting perspective. And perhaps we'll start with Michael here. If you could just give a brief introduction of yourself and touch on how things have changed over the past couple of years.
Yeah, thanks, John. Thanks very much. Thanks, everybody, for being here this afternoon. Yes, Michael Bentley's my name. I'm from MST Financial in Sydney. We're at the core of our product is research, and my area is small cap mining companies. And so this has been a very important theme for the companies, a lot of the companies we cover, and the fact that the market has been pretty soft for the battery metals, related metals over the last couple of years. And I think what the approach you've got to sort of take with these things is that everything's a cycle in our business, in the commodities business. There's we were discussing it earlier that we think lithium's in about its fourth cycle already, and that just when you think things couldn't get any worse, they inevitably begin to recover. So I think the key thing for us is that you really do have to take the long view on these things, and that the whole decarbonisation and electrification thematic hasn't gone away. It's probably extended slightly and got maybe slowed up a little and things like that, but it's still all going. It's going to change, and we can't lose focus on that. That it's still a very, very strong theme, and we need to take a little longer term view on it. Is my sort of view on that. Yeah.
Thank you. And Jack?
Yeah, everyone. Nice to meet you, Jack Rice from BHP Ventures. Upfront apologies for my voice at this point in the week. It's clearly failing already. So, look, I'm assuming in the room there have been a few digs at BHP throughout the day, so people know about the company. BHP Ventures was set up 2020 next to our decarbonisation goals, so naturally it's fitting to tie it to decarbonisation cycles. However, when we set it up, we did it with a tagline of making BHP more safe, making BHP more productive, and making BHP more sustainable. So that decarbonisation angle fits into sustainability. Safety is always a priority at the front. But in the middle, we have something really nice, which is growth. So we've spent the last 5 years really trying to invest in things that decarbonise BHP, but that also help it grow. And now we have a portfolio that is hopefully quite, I'm very loath to say that BHP is cycle resilient, but we have a venture portfolio that is somewhat cycle resilient because we've always invested with that growth in mind. And look, it means that there are some scenarios in which levies or credits may have disappeared or reduced for certain companies, and they've come into spots where they've struggled. But given that we've always had that growth underpinning the portfolio, it's really helped us through that time. So I wouldn't say that our approach has necessarily changed, but we definitely have it front of mind that an investment needs to wash its face always, right? You can't just rely on these credits and individual items. So that I would say that's how we've gone.
Sure. Okay. Thank you. And YJ?
Oh, hi. My name is YJ from Arcane Capital. Just to introduce the company a little bit, because we are so super tiny, nobody knows about us. We manage 2 funds, one in Luxembourg and one in Singapore. The one in Luxembourg has a 15-year history, and over these 15 years, we've sort of outperformed the S&P and Bloomberg green indices by about 8 to 10% per year. So that's the track record. In Singapore, we just launched a new fund last year. We call it the Arcane Green Metal Fund. It's the first of its kind in Singapore, and focused on investing in the miners that produce metals for this huge energy transition that we are in. So my particular focus is lithium and silver as well. And that's because I see these two metals as being critical to the entire energy transition. Lithium, obviously, for the cars, for the buses, for the trucks, for the storage, and most excitingly today, what we are seeing just this week, two companies in China have gotten approvals to launch air taxis in China, eVTOLs, vertical takeoff and landing taxis in China. That's happening right now as we speak. So that's one. And of course, the other focus on silver is because that's the key ingredient in the solar space, right? What not many people know is that solar now consumes about 20% of all the silver being produced in the world. And as the solar build-out continues to expand massively, that is just going to ramp up as well. The next generation of solar panels uses even more silver per panel. So these are the investment themes that we are riding on right now. And to answer your question on change on the decarbonization front, it's more. We see an acceleration. It's not just a change or a shift, but a huge acceleration. Solar panels prices have collapsed, and last year the world installed 600 gigawatts of solar. That's massive, and that's still increasing, right? And on the lithium front, EVs, hybrids, extended range EVs, they are all taking over the ICE world right now. Grid storage is growing even faster than EVs. We love that.
Okay, excellent. And obviously, prices of some decarbonization commodities have come down significantly over the past 1 to 2 years. Some have done well. I'd like to touch on what are you guys seeing in terms of the project financing landscape and the ability to fund projects. I mean, Michael, what are you seeing from that side, and particularly on the equity markets? I mean, are investors placing any value at all on these undeveloped projects at the moment?
Yeah, it's a really interesting thing, and it's particularly prevalent in the smaller cap project-related companies that we look at. That funding is becoming, from a plain vanilla point of view, from the commercial banks, it's getting harder for them to get that, what was the simple form of finance. So they've had to become a little bit more creative and look at different ways to fund their projects, like royalty finance or offtake finance, or selling down to strategic partners. And then, of course, there always has to be an equity component with that part of the funding. And so the equity investors are still a very important part of that funding. And they are looking harder and at the projects and whether they're still valid, under these pricing scenarios, and even in the poor pricing scenarios that we've had over the last couple of years, these projects still stack up, but you need to get that funding in place, and it has become a bit more difficult. But as a result, we've seen the companies getting more creative and looking at alternate forms of finance, and they're coming through. There's new players coming into the market to fund these projects, and it's actually make it quite interesting to see the change in the mix in the fundings, but they are happening without question. Yeah.
Okay. And Jack, I mean, you obviously been very focused on copper, which has had a great run. I mean, what are you seeing in terms of new projects going forward? Ability to bring those online, ability to fund, et cetera.
Yeah, cool. I'll answer the question in a slightly different way and veer away from talking about big M&A quite clearly. So for BHP, look, copper's quite clearly part of our core strategy moving forward. I think Scott showed the charts earlier, so I don't need to get the numbers necessarily bang on, but the line moves one way. I think BHP, we see demand increasing 70% by 2050, which means 10 million tons per annum need to come into the market every year. 10 new million tons per annum need to come into the market every year for the next 10 years continuously. There's only a few ways of getting that. You can try and buy another large mining company. You can find more copper, or you can do some other projects on site or finance new projects. So 3 examples for BHP. I think one would be, think about the Filo del Sol project in Vicuna province with Lundin, our partners there. That's a $3 billion US spend up front for BHP. Then if I think about Escondida, Los Colorados concentrator, we're extending that. That's a $2 billion spend. If I go then in a much smaller fashion, you have modifications and improvements you can make on sites. If I use a BHP portfolio company example, Cibo, who unfortunately couldn't be here today, but a shout to Cristobal back in Chile, they have the work going on with Glencore at Lomas Bayas with a view on improving sulfide leaching technologies to improve recoveries at the Lomas Bayas site. Now, with all of those three in that clear demand picture, you see a clear appetite for spending money and capital to get to that end result and meet that demand. So while that remains true, and while our analysis, which would need to come a long way to normalize, remains there, we have a very strong view that capital will be spent and capital will be available for these projects. Copper is a core part of BHP's strategy, and it's always been a core part of BHP Ventures' strategy as well, to follow mother company down that road. So yeah, I have a strong confidence and strong belief that if a project is justifiable, and all of these projects are, they will find capital and it will be available.
Great. And YJ, you've done a lot of work on lithium, and I know you have some strong views there. I mean, what are you seeing in terms of the supply picture there?
So what's happening with lithium supply is kind of interesting and weird, because all the players in the market say that, okay, this is a market that's going to grow massively to 2030. Last year, the size of the market was about 1.2 million tons LCE, lithium carbonate equivalent. This year is probably going to be 1.5 to 1.6. But by the end of this decade, 2030, Albemarle, the largest player in the market, says it's going to be a 3.3 million ton market. I say it's going to be 4.3, but who cares? It's going to be a lot up from last year, right? About 3 times the size of last year's market. Now, today, many lithium players are trading below replacement value. So the value of the capex that's been put into the plants, into the mines, into the resources, it's the market cap of those companies is lower than the replacement value. And yet, at the same time, this market thinks that, oh, there's going to be so much supply coming online that it's going to be oversupplied for the next few years. So there's this kind of logical discrepancy here, right? On one hand, they're saying that this much supply is going to come online when the prices don't justify it, and yet on the other hand, the market caps of these companies are so small, they're all having problems financing the growth and the development of those assets. Yeah.
Excellent. And I guess this sort of feeds into top picks. So in terms of what commodity in the decarbonization world is going to do the best over the next, say, 2 to 3 years. Let's hear it. What do you guys think, Michael?
Look, I think my number one pick is, and I'm certainly aligned with Jack here, is that copper. I think it's the core ingredient that backs up electrification and decarbonisation. You need it in everything. It's not just in any specific thing. If electricity has to move, it has to move along copper wires and things like that. So I think copper, and along with a supply side that has been stretched for a long time. That's not just a recent phenomenon. That's a long-term thematic in copper. The supply side has been stretched. But I also see opportunities in the other ones that have obviously been, like your lithium and your rare earths, that they have been significantly, down-priced in the last couple of years. You need to have a look at that. And as I said, sort of harking back to my earlier comment at the start, is look at the long term on those things, and that we are in the bottom of the cycle. But I think over time, copper has just got fantastic fundamentals that you can't really argue with. Sure. Yeah.
Okay. And Jack?
Yeah, nice one, mate. Hold on.
Might know what's coming here.
I can give a split answer. I've got one on ice. But no, I think, copper, you're right. I think for us, somewhat obliged to say it as biggest owner of reserves, but we have Escondida, biggest mine in the world. You need to find another 10 of them. No one has or is. So if I then extrapolate that, you have a demand picture that's just going up. You have an extremely strong market that's going to be able to finance anything smaller up to the point of managing to replace Escondida. That's clear. I also then think that there's a strong reason from a ventures perspective to find any investment that does help to fill in that supply picture, those are attractive investments, whether they be equity investments, whether they be small investments. If I think of exploration tech that will help finance Candida, if I think of leaching tech that will help you produce more copper, if I think of electrochemical treatments that also may do that, those become extremely attractive as well. So I would, while not giving financial advice, clearly I would follow those. I think as well, look, I'm loyal to my former self and former role as the lowly uranium sales guy at BHP, which is not an overly glamorous position, taking up 0.5% of our revenue. But I can imagine that the return on capital on some of those things may be extremely compelling, given the demand picture going up as well, and again the lack of new supply.
Yeah, sure. And YJ, what's your view there?
I've got two metals that I think will outperform in the next couple of years. One being first silver, and then followed by lithium. So why silver is because one, like I said, the solar demand, right? And that's a market. This is a market that has been deficit for the last 4 years. And what's been sort of bridging the gap in this deficit is basically bullion stock inventories coming out, being melted down and being put into the industrial use. So we see a space for the silver price to continue moving up. Gold's at a record price. The gold-silver ratio is now above 90. If that ratio went down to 80 or 70, back to somewhat more normal ranges, I could see silver at $45, $50, and that would mean that the current silver market boom continues, in a big way. Lithium, I expect to swing back into balance, undersupply, late fourth quarter this year, or maybe early or mid next year. And when that happens, I think the commodities price move will be probably explosive, because at the current lithium price, maybe about 20 to 30% of the companies actually don't make money, right? We are deep into the supply curve, and when market balances switch, the commodities price tends to move quickly, right? So I think lithium going from 10,000 a ton to 15 or 20,000 a ton is not an impossibility. It was 60 to 80 just in 2022, and when that happens, I think the lithium stocks probably double or treble.
Yeah, right. Okay. Some bold calls. I like it. And Michael, I'd like to ask you as well, from an investor interest standpoint, and you're obviously covering these companies and discussing with investors around them. I mean, what do you think would take for that to come back and say the battery mineral space? I mean, are people going to be just following price, or is there going to be some shift where people start thinking more about decarbonization for decarbonization's sake, or is it just sort of pure economics?
I think on your first question about is it just price, I think that obviously makes up a lot of it. But I think from an individual sort of, if you're looking at project by project or company by company basis, I think it's very important that their projects and their messaging to the market doesn't stall. They need to be showing progress, that they need to be showing that there's potential funding, or that they've got their capital costs under control and maybe reducing them and all that sort of stuff. And that will keep equity investors interested in the story. They might not be buying it, but they'll be at least interested in it and tracking it and trying to find the right time to enter. And I think the fact that commodity prices on a lot of the battery-related metals have come down so significantly, there's interest just from the fact that is there a bargain? Is there some bargains out there? And I think the question you asked about decarbonisation and investing just for economics, I don't think in this space you can really say that they're mutually exclusive. I think the investors take both into consideration, and that there has to be a good thematic behind it, as well as a good project, and then hopefully the pricing goes up as well at the same time, so it'll hopefully gels all at once. But yeah, I think that's sort of what my thoughts are on that one. Yeah.
Sure. Okay. Thanks, Michael. And I mean, Jack, from your perspective, you obviously talked before about projects needing to wash their face from a economics or growth perspective. I mean, I'm curious what you're seeing at other kind of large mining companies or within BHP in that regard. I mean, do you think that ever changes back to sort of where it was 2 to 3 years ago, where there was really, companies looking to achieve decarbonization for decarbonization's sake, and does that need a political change or some change in the mood globally?
So I think us and the other large mining companies, without wanting to speak for other companies, but everyone's pretty clear on their commitments with our 2050 goals. So I think that will remain, and we will do things that get us to that end. I think what's been clear with all the projects that we've undertaken via ventures, if we've gone for strategic implementation, is that decarbonisation for decarbonisation's sake, if it's at the cost of target or true tangible value to shareholders, has not necessarily stacked. We have to remember we're a public company with shareholders, a lot of them, well, some in this room, perhaps, maybe, who we have a duty to return value on, and that value can't be in a percentage turn this year on a decarbonisation goal if we're already on track. So going beyond that target is not necessarily going to stack. But I think then what I do see, if you go to events with the other big mining companies where they present things that they're doing in certain spaces, copper leaching, for example, you will see other companies, and us included, spending money to get to that end. It's just it's coming on the same track as growth, which it means you end up with two good results, hopefully.
Yeah, absolutely. And YJ, how about you? I mean, what are you seeing from the companies or you look at, or other investors you speak with on this?
Yeah, so okay. As a very fundamentally driven investor, I like the way things are today. Why? In 2020, it was a case more of decarbonization for its own sake, right? We had the Green New Deal. We had all the hype around hydrogen, SMRs and all that. Everything was in a bubble, right? And hydrogen concept stocks went up 300, 900%. SMR-related stocks went up, 500%. And things were just out of whack, right? And it was not sustainable. But today, those have crashed, 95, 98%. Everything is cheap. And from a physical point of view, everything is now being driven by economics. Look at cars, right? I can give you a dozen examples. Cars, BYD's cars in China on the low end start at 70,000 yuan, 68,000 yuan, less than $10,000 per car, right? And their luxury cars start at about $20,000, $30,000. That's how cheap things are right now. Grid storage. I think there was a presentation earlier that showed that the LFP per kilowatt hour price is now down to about $66 US dollars per kilowatt hour, right? That we did the analysis on our side. In China, where interest rates are low, the LCOE, the levelized cost of electricity for batteries, runs to about 1 to 2 cents per kilowatt hour. Right? And in the US, where there are higher capital costs and tariffs and all that, it runs to about 4 to 5 cents per kilowatt hour. And that is still cheaper than firing gas or coal-fired power plants at 6, 8 cents. Right? Nuclear, even higher. So everything's now being driven by economics. Everything, physically, things are cheap, right? From the products to the cars to the valuations of the companies. But that's what we like to see, because all this fundamental growth, these real changes happening in the world, new cars being primarily electric, new buses, new trucks, they're all moving electric, and that's all being driven by the low cost of operating these things. That's the thing we like to see.
Sure. Oh, that's really interesting. I mean, I think that it seems like obviously things are in a more sort of sustainable place in terms of both delivering economics and decarbonization than we were a couple of years ago. So that's obviously quite good for the outlook going forward for this sector. So look, with that, I know we're bumping up against time here, so we'll leave it at that. Thanks a lot, everyone, for listening. Thanks to our panelists.
Thank you, Joe.
Look forward to catching up over drinks.
Thank you. See you all at drinks.
Thanks so much.
Thank you very much, John Stover. Ably handled. Thank you so much, panel. A very lively discussion to finish off our day and more to think about. You guys have earned your drinks, most definitely. I'd like to invite everyone else back to our exhibition hall to have a couple of drinks with us and a bit of a chat. Tomorrow morning, really looking forward to seeing you all for our big breakfast. And then, of course, we're starting off with our first discussion of the day. I think we've got Scott Clements in to chair that one. We're looking at silver and investing in silver. It's going to be a really big day. I'm really looking forward to seeing you. Enjoy your evening, and we'll see you back bright and early tomorrow morning about 8:30. Thank you, everyone. All right.